Hello, everyone. Welcome to our Making Sense of Markets Q4 2017 presentation. We'll be covering headlines for the most recent quarter as well as some of the performance figures from the last 3 months of 2017. My name is Josh Kanan, and I'm a certified financial planner, managing partner with Premier Wealth Advisors. I will be your host today, along with my partner, Ari Crandall, also a certified financial planner and managing partner of Premier Wealth Advisors.
Good day, everybody. Thanks for joining us. We have some really good information to go over today.
So here are some of the headlines from 2017 going back to the beginning of the year. You can see February 22nd, 10 reasons to be nervous about the all-time high stock market. That was Yahoo Finance. And then March 21st, worries about stock valuations reach highest since 2001. So even throughout all of 2017 being as good of a year as it was, we were constantly getting these types of headlines. Neither war nor politics can stop this stock market steamroller. So although the beginning of the year it was all about fear, then it became all about, this market's unstoppable. And then this headline that came about from Citigroup, this was a really good one. It caught my attention because it really kind of speaks to our philosophy. And so what happened here, Citigroup had a technological malfunction where the results of its analyst reports were being relayed incorrectly to their brokers and clients. So in a sense, an analyst would write a report saying a company was actually a buy, and the communication to clients and on their website would say sell, or vice versa. And this happened for over 1,800 stocks over the course of 4 years. So what's even more troubling than the actual bug in their system was that the error did not seem to matter to actual clients or to the performance. So basically the ratings of these analysts were essentially worthless, which just shows how this active management and kind of these analysts and the big Wall Street, historically, it's always been kind of they're able to perform, and we've been preaching for years that they tend to underperform. And so this is just another example of that. And then the last headline here is December 31st, valuations are stretched, central banks are taking away the punch bowl, and fundamentals look long in the tooth. And that was Russell Investments. And I really was elated to see the lines long in the tooth in that Russell report, because just last year we had created this slide showing that that particular term, long in the tooth, seemed to make its way into the headlines for basically every single year since this recovery began, back in 2009. So I thought that seeing that headline was quite interesting.
In the next few slides, we're going to be talking about the latest buzzword about Bitcoin, but before we do, we're going to back up a little bit and talk about blockchain technology. So blockchain technology and cryptocurrencies that we're hearing quite a bit about these days. We're going to focus on them more from an investment perspective, as there's numerous articles or videos which can give you a much better primer on the actual working of them than I can in the next few minutes. At a very high level, blockchain is a way to maintain a public ledger of digital information which can be distributed but not copied. Blockchain technology has created the backbone of a new type of internet. Information held on a blockchain exists as a shared and continually reconciled database. This is a way of using the network that has obvious benefits. The blockchain database isn't stored in any single location, meaning the records it keeps are truly public and easily verifiable. So think of a real-world example of this. Imagine that the next time you went to buy a home, you didn't have to go through all of the title insurance and escrow process, because you'd be able to verify that the seller did in fact own the house you were looking to buy, and that you as the buyer did in fact have the deposit for the purchase. The blockchain can validate the exchange without having several layers of intermediaries. This is the hope, at least of many enthusiasts, that transactions as large as home purchases or as small as buying a cup of coffee can be done seamlessly and efficiently between two parties. Blockchain is the technological innovation, while Bitcoin is a means of exchange. Bitcoin came into existence as the world's first decentralized digital currency via a single white paper penned by the pseudonym Satoshi Nakamoto in 2009. Bitcoins were created to act as an incentive for individual computer nodes to expand the effort necessary to update and maintain the blockchains that I talked about. Why has the digital currency that very few people are actually using garnered so much attention lately? Well, remember the dot-com stock seemingly had nowhere to go but up in the late 90s, or how the entire world was going to adopt the Japanese way of doing business in the 80s? Those were previous examples of extreme price increases, experiencing gains of over 500% in a matter of years. Now take a look at just how dramatic Bitcoin's rise has been just over the last year. And so it's easy to see why this is such a hot topic and has so much garnered so much attention. With Bitcoin, much like gold though, it's extremely difficult to know what the value should be. There's no cash flows, dividends, future payouts that you can estimate the present value of. There are erroneous regulatory, cybersecurity, and price volatility associated with the currency. Yet gains like we've seen lately are going to attract a lot of attention and interest for obvious reasons. A perfect illustration of the fever that came in the fever pitch came in this Bloomberg article entitled "The Stock Market Has Gotten Out of the Casino Business." With the byline, this might explain why volatility is so low, a topic we covered again in our Making Sense of Markets videos in the past. All the wild speculators have shifted into Bitcoin. This is a fantastic title and really highlights such an important behavioral concept, the fear of missing out. Our hindsight is always 20/20. I've talked to numerous people that have said, man, if I would have bought Bitcoin back then, I would have had so much money now. Hindsight, like we say, it's always 20/20. And while we all wish we could have acquired several hundred Bitcoin when it was trading at mere pennies, the same can be said for Tickle Me Elmos, Beanie Babies, or tulips at different points in history. And of course, how perfect the actual ads were at the bottom of the page, one purporting you can quit your day job in order to trade Bitcoin, and the other saying, beware of the great meltdown is coming.
So I think that, cryptocurrencies like Bitcoin, which aim to leverage the benefits of this new blockchain technology, are going to be pretty exciting. But as with any new technology, the risks are also going to be high. You think about trying to make investments in other industries based on the foresight that they were going to reap huge economic profits down the road. Picture cell phones 15 years ago and placing a big investment in Nokia just to watch it dwindle while smartphones took over the world. Or being on social media scene and backing MySpace. More than 20 search engines looked to catalog the evolving internet before Google came along. Predicting the future of technology is hard enough, Ari, and predicting who will capitalize on those changes is even harder. So what does the future hold when it comes to this technology? And just as we wouldn't advise investing in any one stock or IPO, investing in any one cryptocurrency or initial coin offering is extremely risky. We just don't know if Bitcoin, Litecoin, Ethereum, Ripple, or some other currency that hasn't been invented yet will have a meaningful impact in the future. I've spent about 25 hours of reading and research on the topic so far, and I still struggle to have any kind of an idea where this thing's all headed. I know, Ari, you've spent a lot of time on it as well. And I've also even gone through the account opening process at a few sites, and I can tell you, it's like the digital Wild West of investing out there. You would want to have a very good understanding of cybersecurity and the risks involved before placing a single dollar of your own money into them. And even then, a colleague mentioned to me a great idea, and any dollars put into these at this point should be considered tuition to the school of capitalism. Sooner or later, you're going to get taught a hard lesson. In the meantime, when we think back to the underlying blockchain technology, well, this isn't a secret to existing companies. Last year, already big announcements came from commonly held public companies like UBS, Toyota, and IBM. And in fact, just 4 days into 2018, the term blockchain had already been mentioned in 110 company press releases. Wow. The fear of missing out on the enormous gains are not going to go away anytime soon. There will also be an asset or part of the market at some point that will look awfully appealing, but investors should keep in mind what they're investing in, why they are invested in it. For many of us, while we didn't see the 1,000% return in our portfolios if we had only held Bitcoin, we likely did see positive returns last year that were likely higher than what our financial plan had estimated, and so we all might still be ahead of our own schedules. The start of the year is always a great time, and we've talked about this many times, to review your financial plan with your advisor, see if any changes are needed based on some changes that might have happened in your own personal financial situation, and not just whatever new cryptocurrency happens to be in the news that day.
Moving on to market volatility and the CBOE volatility index. So we're going to start off by revisiting some major 2017 market themes or environment characteristics. So we'll start with some comments regarding the relative calmness or lack of volatility of the U.S. market during 2017. A good way to frame this discussion is by looking at the performance of the CBOE volatility index, or what's commonly referred to as the VIX, which is the key measure of market expectation or near-term volatility conveyed by the S&P 500 stock index option prices. Since the introduction back in 1993, the VIX has been considered by many to be the world's premier barometer of investor sentiment and market volatility. In 2017, the U.S. stock market was at its most docile in living memory. The VIX saw 22 of its lowest 25 readings ever in 2017, and this was through December 18th is when we had our most recent data. Throughout almost the entire year, realized monthly volatility was at its lowest in at least a decade.
Yeah, Ari, and I think that causes, some investors to get a little bit complacent and think that markets don't have risk. And I think, we've been around long enough, and many of our investors have been investing long enough to know that markets certainly do have risk. And so this is extremely unusual volatility.
Absolutely. Performance as well.
So another way to frame our discussion of this kind of market calmness, Ari, is to look at historical maximum drawdowns for the S&P 500. And when you look at an analysis of these drawdowns, just since 1990, you can see some of these results. The average, annual drawdowns about 9.22%. What we mean by that is from its, peak at that point in time to when, it actually goes back, to its lowest point. That's what we call a drawdown. And so the 2017 maximum drawdown that we even experienced was 2.58%. You can see on this chart that's ranks up there as one of the lower ones. The largest max drawdown during this period was back in 2008, as you can see, and remember that was about 37%, and the smallest was negative 0.36 back in 1995. Meanwhile, on November 22nd, 2016, the S&P 500 closed above 2,200 for the first time, and since then it has set 66 new highs in that very short period of time. Some other notable dates include in February 9th, in 2017, it hit 2,300. March 15th, just a month later, it hit 2,400. September 15th hit 2,500. And then November 24th of last year, right before Thanksgiving or right around Thanksgiving, hit 2,600 on the S&P 500. So yes, Ari, recent volatility is certainly low. And if it were to spike some, and we're starting to see it spiking some, it shouldn't be so worrisome to investors. Because we're currently just below normal levels of volatility. Further, a retreat from equity markets in 2017 for fear of a snapback in volatility would likely have cost investors, some measure of participation in the rising equity markets. I know a lot of people, based on those headlines I mentioned earlier, were thinking, oh, maybe we should, go to the sidelines for a while. Well, you can see you would have missed out on quite a bit of returns in 2017. And finally, as a reminder, diversification can dampen the impact that any one portion of your portfolio can have on the overall portfolio. So we're big believers in diversification. So even if volatility were to pick up in the United States, as we're starting to see it happening right now, a globally diversified portfolio, where you've got both U.S. and international companies, should mitigate some of the negative impact resulting from this occurrence. It's important to stay the course, maintaining a globally diversified mix of assets that are aligned with your given tolerance for risk.
All right, so let's take a look at the U.S. and then we'll take a look at some international. All right, so low volatility has manifested itself in performance in the U.S. And by looking at the S&P 500 as a means to measure this. So the S&P 500 index is comprised of a broad and diverse group of stocks. Generally, these are U.S. stocks with the largest market caps, and as a group, they represent approximately 75% of the total market of all publicly traded U.S. stocks. So we've assembled a heat map for some historical returns on a monthly basis dating back to 1926. The cells that are shaded green indicate a positive monthly return for the index, while the ones in red indicate a negative or zero monthly return. Notice that for 2017, all the cells are shaded green, indicating a positive monthly return for the index for each month of the calendar year. This is the first time on record that the S&P 500 has risen every single month during a calendar year. It's unprecedented. So that's the bottom row in this chart if you read all the way across.
Yeah, that is certainly amazing to see it green every single month, and like you said, it's the first time that's ever happened.
So the other piece of the pie, or the puzzle, if you will, is the declining dollar was a 2017 trend, and that provided a nice tailwind for international investment performance. For the year, the dollar finished down roughly 8.6%, even as the Federal Reserve raised rates. Investors seem to be more bullish on economic recoveries in Europe and other parts of the developing world, and worried of a potential U.S. slowdown. So they've been buying international currencies at the expense of the U.S. dollar. This is a good reminder of why you want to have a diversified portfolio. If you stuck all in the U.S., that's going to impact you. You've got to have some international as well, generally speaking. So every quarter, the change in the dollar will impact the value of those international investments, right? International investment performance has benefited in recent quarters from the dollar decline. In prior years, there's been a negative impact from the strengthening dollar, thus hurting the internationals. Much like stock markets in general, no one can predict which way the currencies are going to go next, but having exposure to a variety of investments, international and domestic, within a portfolio can help provide additional layers of diversification and to mitigate some downside risk. Look at the currency impact on index performance. All right, so the return on international stocks can be thought of as having two components. The first is being the return of the stocks on their own local exchange, say like London, Frankfurt, or Tokyo, in their local currency. Then you have the currency impact. When the US dollar declines in value, those foreign stocks denominated in other currencies are now worth more when translated back into dollars. We can see this impact for 2017 as the index of international stocks gained 14.6% on their local exchanges, but also benefited from the dollar declining by up to 9.6%, meaning overall gain for the quarter to a U.S. investor was 24.2% for international, just broadly speaking.
And we've been talking, Ari, for several years when the U.S. was, outperforming international. To stay the course with international, you never know when the tide's going to turn, and certainly we've seen that happen in 2017. So those of you that have been patient with the international side of the portfolio, you're now seeing some good benefits there.
Yeah, no doubt. International, admittedly, prior to 2017, international was a tough category to be in because you did have some negative returns in a lot of those sections for multiple years, but now you're seeing the tide shift.
So just another way to graphically show, the performance around the world and why we choose to diversify into lots of different regions within our portfolios. You can see this performance in the fourth quarter, and returns often differ in stock markets around the world, and you can see that this particular quarter was no exception. And so in North America, you can see was up about 6.3%, and then you can see South America down 2.3%. Elsewhere, Asia was the strongest performing region for the quarter, gaining 8.3%. And then you had Europe, Middle East, and Africa at 2.2%.
So you can see international once again, good spot to be in with the declining dollar, helping those sections out.
So now I'm going to look at the size and style impacts and how those things impact the performance. As many of our clients know, we tend to tilt our portfolios to value in small companies. And so looking back at the last quarter, we saw positive results for most asset classes, as you can see here. While large growth stocks led the way in the United States, small growth stocks were the top performers in international markets. Looking back over the last 15 years, we see a similar trend, both U.S. and international stock markets rewarding investors who stayed invested specifically in the small and value segments that we tend to favor. In the U.S., a tilt towards small company stocks versus large company stocks has rewarded investors with a 15-year annual premium of about 1% on average. And we arrive at this calculation by subtracting the return of U.S. large company stocks over the 15-year period from the average return of U.S. small company stocks over the same period, and that's where we get our 1% annualized premium. However, investors tilted towards value versus growth have experienced relative annual underperformance of about 0.7% on average during that same time frame. If you go back further in history, you can see that there has been a significant premium on value, but with the most recent time, it's been a slight negative, as you can see here on the slide. Looking at international, investors tilted towards small and value stocks captured average annual premiums of 4.2% and 0.3% respectively. Similar to our calculations of the premiums in the U.S., we subtracted the average 15-year returns for international large and growth stocks from the average 15-year returns for international small and value stocks respectively. So in general, investors who stayed invested and followed our strategy of tilting their portfolios towards small cap and value companies, both in the U.S. and international allocations of their portfolios, were rewarded with higher returns than a non-tilted portfolio over this same period.
All right, so now we're going to take a look at another slide on diversification. And looking at the most recent quarter's asset class returns, we can see that asset classes in the portfolios ranged all the way from 6.8% positive for emerging markets on the high end to negative 0.2 for U.S. short-term bonds. So just going left to right on here, just to make sure everyone understands, it's emerging markets value, U.S. large cap, international small cap, U.S. large cap value, international large cap value. In the middle is a 65-35 blended portfolio, 65% stock and 35% bond. That's shown in white. And that kept you away from the more extreme returns year to year with significantly less volatility over the last 15 years. So this highlights the importance of maintaining a well-diversified asset class mix in your portfolio. You can see the sections in white on this chart. They're generally in the middle of the road and no extremes one way or the other. So this is diversification will help mitigate volatility in quite a big way in some instances.
Yeah, we've always said that you're never going to make a killing in it, but you're never going to get killed by it, meaning that you're never going to be at the very top, but you're also never going to be at the very bottom. That's what diversification is all about. We love this chart. We call it the Skittles chart. We've used it for many years, and it just shows how difficult it is to predict what asset class is going to be the best performer each and every year.
Yeah, I mean, look at 07 and 08 as an example. Emerging markets was up 42% in 07 and down 50% in 08, right? I mean, it's easy to say, oh, I should have been in emerging markets. Let me put everything over there. And then if you did that, the next year you would have been, substantially impacted. So you can see the winners always rotate. And that's why you want to diversify. Next slide, we're going to look at the absolute impact of different asset classes on a sample, on that same sample, 65% stock, 35% cash and bond portfolio. And you can see the largest impacts to performance were driven by international large value stocks, U.S. large cap stocks, international small cap, and U.S. small cap. So the overall gains on this index mix for the fourth quarter was 3.35%. So what this slide is showing is by having a diversified portfolio and including these different asset classes, how that adds to the overall return in the portfolio.
So looking at just, what's happening, economically throughout the world, robust growth rates and the synchronized global growth, did fuel much of the gains that took place in 2017. All 45 countries tracked by the Organization for Economic Cooperation and Development, OECD, are on track to grow this year, and 33 of them are poised to accelerate from a year ago. It's the first time since 2007 that all are growing, and the most countries in acceleration since 2010. In the past 50 years, simultaneous growth among all of the OECD-tracked countries has been pretty rare. In addition to happening last decade, it has only happened in the late 80s and for a few years before the 1973 oil crisis. So economically, things are going very well. With much of the growth being priced into the market, we don't know that it will translate necessarily into another double-digit gain year in 2018. However, as our chart indicates here, from a global growth perspective, the outlook is pretty positive. Growth projections, although decelerating, indicate continued growth throughout the world, And so that certainly is positive. So this concludes our presentation for today. As always, if you have any questions, please don't hesitate to reach out to us. We're always here to help out. And if you haven't had an annual review in a while, it's a great time to give us a call and get on the calendar.
Yeah, absolutely. And just a reminder, we're here as a resource for our clients, even if it's, hey, I have a question about, why we're investing in a certain asset class or certain category, or revisiting the investment allocation and making sure it's relative to what's going on in this stage of your life. Just reach out to us and we're here to help.
Have a great day.